When you look at this question 1, we have to prepare a paper to the CEO suitable for presentation at the next board meeting. That includes A, an evaluation of the proposed diversification to cosmetics using APV. That is part A. Then part B, we are to include in our paper, we have to include advisory on the appropriate portfolio of investments to undertake using covariance theory. So this is portfolio. This is portfolio analysis. But the examiner decided to include the portfolio analysis on question 1. It's an area that we are going to discuss separately, portfolio analysis. We are also to include justification of the opinion of the finance manager and discussion of the composition and role of Sharia advisory board. Justification for complying with sustainability and environmental management practices at organizations like DHL. Okay, so part C and part D, it was basically theory. I will not discuss the part B because we are going to discuss the portfolio analysis on its own. This was just the portfolio. This paper was, there was portfolio here, question 1 and question 2. Takes a lot of time. Easy but time. Easy but time. Okay, so let's see how we can answer part A. When you look at this question, they are telling us that DH was established in DHL was established in the year 2000 and operates in the textile sector. Since incorporation, DHL has controlled a significant market share of textile sector in Uganda and has established a regional outlet in the neighboring countries in order to increase its regional presence. Guys, as we prepare for December paper, I want to discuss also more about international market.
Which question paper is this?
December 2024.
Oh, okay, thank you.
Remind me, we needed to do a number about a company having investments in Uganda and Kenya and how we do the computation. At its recent board meeting, it was resolved that the company diversifies its operations to cosmetics sector by establishing a production facility that will produce a wide range of cosmetics for sale in Uganda, with a few exports to the regional market. So you see, initially, this is a company that was in textiles, textiles sector. Okay, here they are telling us that DHL has an equity beta of 1.15. That is the company, 1.15, and its existing capital structure comprises debt and equity in proportion of 35% and 65% respectively, which also reflects the company's debt capacity. Preliminary data has revealed that the cosmetics sector, where you are going, okay? The preliminary data has revealed that the cosmetics sector has an average equity beta of 1.35 and debt to equity ratio of 2 to 3. Any diversification to the sector will increase DHL's capital gearing to 45%. Now, colleagues, every time you find that you're diversifying and your capital structure is going to change, whether it is going to reduce or increase, as long as you realize that the capital structure is going to change, even if examiner does not say that you use APV, automatically you have to use APV. As long as your capital structure is going to change, you have to use APV. So you see that here they have told you that any diversification to the sector will increase DHL's capital gearing. Automatically, it means that here the debt is going to increase. The debt is going to increase because of this investment where you're going. Okay, so why are you given this information? Of course, if you're to use APV, you need asset beta. You need asset beta. As long as you're going to use APV to discount your cash flows, you will need asset beta. You need asset beta as you determine the return on, as you determine the cost of equity. You use asset beta. You use asset beta. Because when we are discounting, when we are using APV, we discount using the cost of what? We discount using cost of the cost of what? The cost of equity. The cost of equity, which is ungeared. The cost of equity, which is ungeared. Okay, so we can even get it from here. Me, I have read through this question. I will just immediately be going through some paragraphs that are essential. Now, when you're reading in those 15 minutes, in those 15 minutes, these are some of the things you should be identifying. You should be identifying. Now, the first note I'm going to do here, because as I use APV, I need the cost of equity in an geared company. When you are using APV, guys, when you are using APV, we use the cost of, okay, here these are your workings appendix. We will draft the template later. So working in appendix, this is your appendix 1, and you're going to look at the cost of what? You need the asset beta. You say from to get your asset beta, you say from what? From do you recall the formula? From asset beta is equal to what? Asset beta is equal to what? Those who recall the formula, asset beta is equal to what? When you are ungearing, asset beta is equal to what? Do you have equity beta? This is where you are going. Pick this from. You are going to what? To cosmetic sector. So pick the equity. Yes, please.
When you're getting the equity and the debt, which proportions do you use? Do you use them for the company or for the project?
Remember, here when you're ungearing, you are standing in the business where you are going. Use the proportions of the project where you're going. Okay, that is the first step. The first step here, you're trying to ungear. You ungear the finance risk in the what? In the cosmetic sector. Okay, you ungear. Remember, this equity beta, it contains both the debt and the equity, but asset beta looks at only equity. It doesn't involve debt, the asset beta. Okay, so we substitute what was our equity beta in the cosmetic sector. The asset beta, the equity beta was what? This is the equity beta here. 1 point what? 1.1 or 35. Then you're given a debt equity. It will help you to know what is your E, what is your D, debt to equity. So it means that your debt is 2, your equity is 3. So you can substitute. Here you can substitute. Where you have E, we are putting what? The equity is 3. Then you divide by, E is what? E is 3 plus D is what? D is 2 times 1 minus 0.3. Then whatever you get, you multiply by what? Whatever you get, you multiply by 1.35. Let me open how it is okay. What is your answer? What do you get, guys?
I'm getting 0.92.
0.92. All of you, that's what you're getting. Please use your calculator. 0.992. All of you, that's what you're getting. All of you, that's what you have. Okay. So that is our asset beta. That is the asset beta. Once you have the asset beta, please note the difference. Remember, we have already discussed the things of capital, cost of capital. When you're looking for cost of capital, the work, the appropriate cost of capital, the other work, and you realize that you have the project where you're going, but you are looking for work. Here, you don't stop on this step. You ungear and regear. That is when you're looking for work. But here, we are not looking for work. We are looking for the cost of equity. The cost of equity in an geared what? In an geared company. For us, we need the cost of capital in an geared company. But when you're looking for work, you ungear, go ahead and regear. When you're regearing, now you see how will the project be financed. Please, if you missed the session about the work where we have an gear and regear, go back and listen to the recording. So with APV, the moment you get asset beta, simply go and compute the cost of equity in an geared company. So that will be your KEU, the cost of equity in an geared company, which will be RF plus the asset beta, this one, the asset beta, this one. You don't use equity beta now. You use the asset beta. Then this is where the difference is. Okay. So times the RM minus RF. So what will be our cost of equity? RF, are we given RF in this question? Are we given RF in this question? There is a paragraph where they told us this paragraph, the equity finance will be raised. Okay. Just here. The risk-free rate of return is 10%, and the annual average market return on investment in the cosmetics sector averages to 21%. So this is what you're going to pick. RF is 10, then RM is 21. You pick that. So here RF is 10%, 10%, then plus 0.92, then times open bracket 21% minus 10%. What do you get? What do you get? Please put some speed, Put some speed. You get 10. Pardon? 20%. Okay. So that is our rate we are going to use when we are discounting the cash flows. When we are discounting the cash flow, this is the rate we are going to use. Okay, so we are done with that. We are done with that. So please take note that if you're dealing with APV, all you need is to get the asset beta, then you use that asset beta to get the cost of equity, which is ungeared. Okay, that is step number 1. That is working number 1. Then working number 2, of course, now we are going to go into details of interpreting the questions. We see what we are given. Okay, here they are telling us that the proposed diversification to the cosmetics sector will necessitate initial capital expenditure of shillings 9,500 million required to finance acquisition of production machinery, installation, and setting up the facilities to be ready to commence the production. So here you have the initial outlay. Very, very key, because it will be part of your what? It will be part of your template. Here they are telling us that DHL has so far spent shillings 340 million. Has spent that 340 million to carry out preliminary studies necessary to inform the company's investment decision. The proposed investment will yield economic benefits for a period of 5 years, after which it will be scrapped at 20% of the initial capital expenditure. Now, here, your scrap will be what? Your scrap will be what? Are you going to use this 340 anywhere?
No.
This is sunk cost. It will not be applied anywhere. You have already spent that money. It will not apply. You will not. It's not a relevant cash flow. So for you, as you get your scrap, you will simply get 20% times the what? The initial capital, the expected initial capital expenditure. So it is 20% times 9,500 as your scrap. The scrap. But of course, here you don't need really to do this. Is something that you can do even in the what? In the template. But if you want to output, it's also not bad. The scrap will be 20% times the initial capital expenditure. This is what the facilitator was talking about, that we waste time doing things which are even not adding up our maths. You can do this on the face, 20% times the 9,500 million. You get the answer. So that is the scrap. But remember also, from what we discussed in our August paper, we say that you can go ahead and get the net. Okay, we will see how after getting the capital structure, the way, and after doing the capital allowances. But I want you go with the method that is easy for you because there is no difference. Okay, so that is our scrap. We proceed with the question. Let's proceed with the question. Here you have like 2 marks to identify the initial tray and also the scrap. The moment you add this 340 to this, you're gone. Okay, so from this question, from this paragraph, you have also seen that the economic benefit is for a period of 5 years. Okay, the annual revenue expected from the proposed diversification, the annual revenue expected, this is relevant, from the proposed diversification is estimated at shilling 7,500 million in the first year of operation, increasing by 10%, increasing by 10% in each of the subsequent years, before declining by 5% in the final year of operation. The direct costs associated with the proposed diversification are estimated at 35% of the respective revenues. So here it was a bit easy. Once you have the right revenue, you can immediately get what? The direct costs. But remember, before we go to the next paragraph, somewhere they told us that all estimates of cash flows stated above are quoted in current terms. This is what examiner was talking about. Is examiner. All estimates of cash flows stated above are quoted in current terms and will be affected by annual inflation, which is projected at 8% effective year 2. So this one, the inflation was constant. The inflation rate was constant. It's not like December, the one we did of August 2025. This one was constant. So what you're going to do here to handle the working of revenue, you guys these days you oversleep. You gave up on a Saturday session. You don't remind me. You don't remind me that Saturday session you gave up. Okay, so here we are going to look at the working for revenue. Here we have the years. We have how many years? 1, 2, 3, 4, 5. Okay. You have the nominal. You have the nominal. No. The real cash flows. The real cash flows. The one before you add just, or the one in the current terms. The one in the current terms. When you look at the question, the examiner told us that the revenue expected from proposed diversification is estimated at shilling 7,500 million in the first year of operation. So that is first year of operation. I first put that 7,500. We can say in our figures in what? Shillings in million. That is the first year of operation. First get real cash flows before adjusting for inflation. First get real cash flows for each year. for each year before adjusting for inflation. It will help you. Okay. So yeah, too, they told us that this revenue is going to increase by 10% in each of the subsequent years before declining in the final year. So it means that here you are going to be increasing this figure. You increase this figure, you get 5%. Okay, Excel, you know it can just do these things clear. It's not 5%. I get this figure times 1 point what? If it is increasing by 10%, it is 110%. Is it okay, guys? Is it increasing by 10? Yes, increasing by 10. So you increase this figure by 10, that's what you get. Again, you increase the previous figure by what? By 10, 1.1. Then I also do the same. I also do the same here by 1.1. But in the final year, they told us that before declining by 5% in the final year of operation. So what are you going to do in the final year? What are you going to do in the final year? I want to hear from you. What are you going to do in the final year?
In the final year, we discount by 95%.
Because it is going to decrease by 5. So it is this figure times 95%, 0.95. 0.95. It is different from saying that the rate is going to decrease to increase how the way examiner normally state it. The rate can change from he can say increasing to 8%. Increasing to 8%. Like here it was increasing by 10, 10, 10, but in the final you can say increasing to 8%. So if in the final it is going to increase by 8%, you don't multiply by what? You don't multiply by 1.1. You multiply by 1.08. Okay. So once you have your real cash flows for each year, then adjust inflation here, the inflation. All estimates of cash flow stated above are in current terms and will be affected by annual inflation, which is projected at 8. Here you put it is starting, first of all, it is starting in year 2, 1.08. Then it's not constant because this one keeps on increasing. Every year the rate is increasing. So you get what you had initially. You square it. That's that is the best way you use. You say that you square it. So I can get what I had times 1.08. Because this one keeps on increasing by what? By 8%, 8%, 8%. It's not like that inflation is going to be constant 8% throughout. No. If inflation was 8% in the previous year, if you had increased it by 8%, of course this figure is going to increase in the next year. So that's why you'll find that people are doing like this. It was 1.08 power 4. This is what we are really doing. But for me here, on a calculator, the moment I put this, then next I get this times 1.08. Then here I get this times 1.08. Then even here I get the one I had here times 1. You'll be having these figures on your calculator. You just keep on multiplying, 0.18. That's what I have. Nancy, are you now okay? You had a question?
No, it's okay. I get it.
Okay. So the moment you get this, then now you can get the nominal cash flow by multiplying. Here the nominal cash flow will be just this. Then here it will be this times this times this. Okay, I just you see Excel makes life it be easy. So this is your revenue computation. This is your revenue computation. If you're sharp, you can even do it. You can take your figures like in your template. Because you don't need really to do this working. You see, we waste time. You don't need to do this working of direct cost. Here, examiner told us that the direct costs associated with the proposed diversification are estimated at 35% of the respective revenues. I have revenues. So if I'm doing that template, I will put revenue. Then next I put direct costs. Already I have revenue. So every year where I have revenue, I multiply by 35%. Oh, if for you, you want to, but I don't really encourage, you can go ahead and put here the direct what? The direct costs. But you could do this in your template. So direct costs in year 1, it will be 35% times what? Times this figure. Then in year 2, it's still this one times the 35%. Then in year 3, this one times the 35%. Then they told us that in year what? Because that was from year 1 to year 3. And 45% for years 4 to 5. So when you're dealing with year 4, you multiply by 45. You get this times 45. Then here you get this times 35, rather 45. You're done with that working about, but I advise you do this on your template. Do this on your template. Okay, we are done with that paragraph. Any question on that? Here you don't need to adjust for inflation. Already these figures are adjusted for inflation. Okay, next. We are done with that paragraph. Next. They are telling us that diversifying operations to the cosmetics sector will increase DHL fixed costs. If you want to understand these things on a personal level, because you see discussion things are always easy sometimes. On a personal level, get questions from, let's say, 2020. Pick on the paragraph talking about fixed cost. Pick a paragraph talking about let's say, working capital. Pick a paragraph talking about capital allowances. You will see that now things are starting to become very what? Very easy. You do those numbers on a personal level. Then when you're confused, it's when you ask. When you're confused, sometimes those guides can confuse. When you're confused, you ask in the group or you in a box. But you try to do on a personal level. Try to interpret. Here they are telling us that diversifying operations to the cosmetics sector will increase DHL fixed costs currently at. So this is existing fixed cost. This is existing fixed cost, 2,400 million. But you diversifying your operations to cosmetics sector will increase fixed cost by what? By 30% in the first year of operation. Remember, when you're doing this, when you're handling a question about fixed, not about fixed cost, you need relevant cash flow. You need relevant fixed cost. What is the impact on your fixed costs if you are diversified into the cosmetic sector? So it will increase by 30% in the first year of operation. The relevant fixed costs will increase by, okay. So here, let's do this. Here, let's do this. Number 4. Number 4, it's talking about fixed costs. Fixed costs. First of all, you start with real cash flows, the one before you adjust for inflation. Now, deal with directly the relevant. Here you need just the relevant. You get initially it was what? Initially it was what? The existing fixed cost. It was
2,400.
2,400. So I get that 2,000. Okay. How can I get the shortcut? The shortcut. You get 2,400. Then times that 30%. 0.3. This is the one this will be the increase. Yeah. Other people, you first get let's say 1.3, because if it is going to increase by 30%, it means that is 130. So 0.3 times 2,400. You first get the total fixed costs. This is the total fixed costs. Total fixed costs. Then you remove the existing. But you see, you'll be wasting time. You remove the existing fixed costs so that you can be left with what? With the relevant. So the existing fixed cost is 2,400. And the balance here, the relevant fixed cost is the difference. The difference. This one minus this. You get this one minus this. So you see here, for you, as you do this working, you just need the relevant fixed cost. So there are those who prefer to first go this way. But me, I need the relevant. I don't want to waste time. After all, just pay attention. Pay attention to what is increasing. Here, this is where we make mistakes. What is increasing is the relevant fixed cost. That is what is increasing. The relevant fixed cost. So since it's relevant fixed cost that is increasing, I'm going to increase my 720 by 8 annually in each of the subsequent years before declining by 6% annually effective year 4, before declining by. Okay, so here it will be in year 2, it will be what? It will be this figure times what, guys? Someone tell me.
1.08.
1.08. This is what you get. Then next. Next here, it's this one, the one you have up. It is going, you get that one times the 1.08. Then they said that what? They said before declining by 6% annually effective year 4. So year 4, what are you going to put in year 4? In year 4, what are you going to? You get this figure times what?
0.9. 0.94.
0.94. Yes. If you see, examiner say that decline before declining by, the percentage is always 100%. If they say declining by 6, you're left with only what? You're left with only 94%, which is the same as 0.94. Okay. Then also here, it will be this, the one you had. This one times 0.94. All right, so that's what I have. Then I adjust for inflation, the inflation bit of it, the inflation. Already I have the inflation. I don't need it again to compute the inflation. I just put. Oh, sorry, inflation is starting in year 2. So then you go ahead and get your nominal cash flows, your nominal fixed costs. This one, year 1, it will be this. Then year 2, it will be you multiply. I multiply. Any question here? We proceed to the next. We proceed to the next. See, done. Okay, then in addition, the diversification will necessitate additional investment in working capital. It will necessitate additional investment in working capital equivalent to 40% of the existing companies. Sorry, 40% of the company's existing working capital of shillings 7,200 million. Okay, if you diversify, your working capital will, okay, you will need to add, some money, 40%. Okay, we'll necessitate addition. Okay, to 40%. They are telling us that the relevant working capital will increase. This word is very, very key. You need to know what is increasing. The moment for you, you just increase some, you need to know what is increasing. Is it relevant or it is the total? Because sometimes you will be having the total working capital and the relevant working capital. So you need to know what is increasing. Here, what is increasing is the relevant working capital. So first get the relevant working capital. And the fact that they have told us that at the end you will recover, this is not a going concern. This is not a going business. If you realize that you're not going to recover in year 5, you put dash. Because sometimes you find that this end of the useful life. Okay, so what we are going to do is the working capital. Please get those questions from 20, if you can, from 2020. Do those workings of working capital, capital allowance, fixed costs. You'll be familiar. Working capital. Working capital. All our amounts are in millions. So all our amounts are in millions. When I'm doing the working capital, this one, I normally even include year 0. Sometimes I include like year 0. Okay, so you need the relevant working capital. When I'm doing working for this one, I normally include year 0, because you see, before you go to year 1, you need money. You need money to use in that year 1. You invest now, then you use that money in the year you are going to operate. So you need the money now, the working capital. So what you're going to do, first of all, you need the, when you look at what the examiner has said, basically this one was easy, Focus on the relevant. If you diversify, they are telling us that if you diversify, there will be additional investment in working capital, which is equivalent to 40% of the existing working capital. So simply get 40% times 7,200, because that is the money that is relevant. It is the money that is coming because of this diversification. So here you simply get in year 0, you simply get the 40%, the 40% times 7,200. Is it 7,200? Yes, you get the answer. You get the answer. Okay? They are telling us what? So it means that in year, you will need to invest that money in year 1. Okay, they are telling us that here, the relevant working capital will increase by 15% in each of the subsequent years. So I increase this relevant capital. This is already relevant. This times what? If you're increasing it by 15%, this is 1.15. I keep on increasing the relevant by that, 1.15. I keep doing that. I keep doing up to year 4, up to year 4, because in year 5 you're going to recoup. So you increase this by 1.15. You increase this by 1.15. Then in year 5, this will be you recover, you recoup. So we'll see how much you're going to recoup. Now adjust inflation. So you will need inflation for year 4. Okay. So here it means that the figure you need in year 0 is this. These ones you put them in bracket for you, since you're using your book. These ones are. This is outflow. So you put that money. You put that money in a bracket. You have to spend that money. So here we are getting this times this. And then here this times this. Then we need to recoup. We need to recover. I assume you're putting these figures in a bracket. They are negatives, like outflows. So what we are going to do to recover, for me, what I'm going to do, this is cumulative working capital. This is the real, I can say the real cumulative cash flow. Then here I also, this is nominal accumulative working capital. But remember, when you are dealing with working capital, you don't need to use this in your computation. We use the incremental. The incremental. This is like the total, the money you need. If you want to invest in year 1, you will need this. And then in year 2, you will need this. In year 3, you will need this. In year 4, you will need this. In year 5, you will need this. But what you do as you handle your question, for you need the incremental working capital. Okay, of course, year 0, you will need this. That is your basis. Then already you have invested this money. Out of what you need next period, you have already invested this. So in the next period, you just invest the balance. This one minus what? Minus this. You just inject more. You inject only this. Then next here, you get this minus what? Minus this. I hope you're following. Then here it's this minus this. Then here in year 4, this minus this. Then finally in year 5 you recoup. In year 5 you recoup. This is the total you will recoup. But of course, when you add these figures, these ones should give you that total. Should give you that total. Should give you this total you have here, because you should recoup, you should recover that money. Okay. Okay, for you, put these figures in bracket. Then this one is a positive, is an inflow. This one, this is an inflow. You will put in year 5 in your template as an inflow. These ones as outflows. These ones are outflows. These ones are outflows. Any question on working capital? We are done with that computation. This working. Yeah? So that when you are increasing, decreasing, know what is increasing. Is it relevant? Is it the relevant that is increasing or not? Okay. Next. We are done with this paragraph. Then next there, that's that. Yes, please.
Yes. Before we continue, you said when you're increasing, you need to know if it's the relevant or what increasing.
The relevant or the you see what we had initially. For us, you see here we just multiplied 40% times the existing. 40% times the existing. Sometimes you may find that it's the total. It's the total that is increasing. You find that initially you're supposed to get 1.14. Rather, okay, yeah, 1.14 times what was the figure? The figure was what? What was the existing working capital? What was the existing working capital?
7,200.
7,200. So you may find that it's the total that is increasing, not the relevant. So this is the total. This is the total. This is the total. This is the total what? The total fixed, the total working capital. But this total includes the existing and the one that you injected. So this is the total working capital. You may find that it is the one that is increasing. Now, if it is the one that is increasing, first increase. Then after increasing, you will come here and remove the existing working capital, because you'll be looking for the relevant. So first increase this, after increasing it, then remove the existing, which is 7,200. And this one will be constant, 7,200. This one remains constant every year, 7,200. So if it's the total that was increasing, here we could get like this one times the increase was what? If it is the increase of 10%, okay, following what we had, following what we had here, they said that the relevant working capital will increase. Now they can say that the working capital, they may not specify. They can say the working capital will increase. Without the word relevant. Or the total working capital will increase. So you need to pay attention on what is increasing there. So if they have not specified, probably it may be the whole what? Working capital, the existing and the what? The existing and the one you injected, the one of 40. Okay, so you get this one, the total times 1.1. You get this, the previous one, times 1.1 times 1.1. You first increase this. You first increase this up to maybe what you're doing. Now, after getting these figures, what you do, of course, you remove the existing working capital. The existing working capital is constant, 7,200. And I will be in a position to get my relevant working capital. How do I get relevant? I simply subtract. I get the difference. I get the difference. Once I have the relevant, now I adjust for inflation. Before I look for the incremental, I first adjust for inflation. I first adjust for inflation. The inflation may be like this. I adjust for inflation. I adjust for inflation so that I can get the real, the nominal working capital. I get this times the, I don't know whether you have now the hint. That's what you do. Now, after that, you look for the incremental working capital. Incremental working capital by getting what you have here in year 0 or in year 0, then you get the difference. This one minus this one. Then you keep doing. These are the ones you take in your computation. So pay attention on what is increasing. Is it the relevant or not? If it's the relevant, increase the relevant. Okay. Zam, you're the one who asked. Is it okay?
Yes, it is okay, Abby. Thank you.
But practice, you will see, the more you practice, you will see that the language will start to come out clearly. Do like 4 past paper questions about working capital. 4 to 6, you will appreciate. Don't look at the guide. Don't look at the guide before doing. So we are done with working capital working. Let's look at also the capital allowance working, the tax relief, the proposed capital expenditure. The proposed capital expenditure will qualify for annual capital allowances at a rate of 25% on reducing balance. Here, pay attention. Is it straight line or reducing balance? It is 25% on reducing balance for only 4 years. Okay? For only 4 years. But they are telling us that, remember, first of all, you are aware that the project takes how many years?
5 years.
5 years. But they are telling you here, you qualify for annual capital allowances. This is like wear and tear. You qualify for only what? For only 4 years. Okay, let's continue and see. DHL pays annual corporation tax rate at 30%, payable in the year in which taxable profits arise. Okay, that is the first statement. But has negotiated with the tax authorities and received approval to pay annual corporation tax a year in arrears. And this approval will be applied to the proposed investment. Very, very, very key. If it is a year in arrears, My guys, this is like, treat this like 1 year in arrears. Like you, if year one, don't claim. Claim the one of year one in year two. That's what we mean here. A year in arrears. The one of year two in year three. The one of year three in year four. Then if examiner had not added this one of uh corporation tax a year in arrears, if at all we are dealing with, let's say, this one, taxable profits, like you claim the tax relief in the year in which taxable profits arise. If you make profit in year one, you also pay tax in year one, and you can claim your relief in year one. That's what we could have done. Eh? But because of this second statement and you have received approval, the one of year one will be claimed in year two, one of year two in year three, like that. So for me, from what I have observed with what is happening with that examiner seems to be treating a year in arrears as in arrears. Hmm? Looks like you're Nancy, you're the one who asked about this some time back, eh? Actually, for him, he looks to be consistent. In arrears, same as 1 year in arrears. When you do numbers, you see him more consistent in that way. Just so that you know, people who teach can have different interpretation. Hmm? Okay, so here, can you do this working? Is it hard? Can you do in just like 3 minutes on your own? Are you doing? Remember? Okay. Okay. Yeah, 6. You guys, I will give you mock. I told you which date. I told you which date. I will give you mock. Are you preparing for it? First of all, here the asset was acquired on the machinery, where is it? The proposed diversification to construct, okay. Initial capital 9,500. Okay, this amount was to finance acquisition of production machinery. So this is what you claim. You claim wear and tear on your asset. Based on this money. Based on this money. So what you're going to do, here you can have your years.
Okay.
Tax saved. Then maybe the timing can for you to, but don't waste time. Here the timing, do the timing in your template. If you want the timing, when are you going to claim the tax relief? When are you going to claim this tax saved is like the tax relief? Okay. So in here you have how many years? 1, 2, 3, 4, 5. Okay. You need to pay attention. You need to pay attention. Don't cram, eh? So here, like also here, sometimes you put like there are also those who put year 0, eh? Just have the basis. The basis, I'm going to start with 9,000, 9,500. Just the basis. Of course, in year 0, no depreciation. Eh? But now I start depreciating. It is on reducing balance. I get here 25% times this. Then here you'll be having what? This one minus this. Then in year 2, I get this one times 25. Remember, you'll be basing on the previous, if it is you're looking at net book value of the previous year, written down value of the previous year to get the capital allowance of this year. Then here I'm left with what? This one minus this. Then in year 3, I get this times what? 25%. Here I'm left with what? This one minus this. Let me see the question. They said what? You need to follow the question. You need to follow the question very well. For you, if you just do, may just be wasting time. How many years are you going to claim capital allowance? How many years are you claiming for all the 5 years? Here they told us that you qualify for annual capital allowances at 25% on reducing base for only what? For only 4 years. So in year 5, you don't. So we saw that in year 5, you don't qualify. So in year 4, you can claim this one times 25%. So here in year 4, you'll be left with written down value of this. All right, now you have claimed your capital allowances for 4 years. The question is,
Share the screen.
Pardon?
Share the working screen.
What are you seeing?
The question paper.
You have been seeing the question paper.
Yes.
So you don't know how I'm getting these values.
I know.
Okay. All right, so let's now get the tax relief. Let's now get the tax relief. Remember the tax relief. You are claiming the tax relief in which year? This is 1 year in what? You are claiming the tax relief, or you're claiming the tax credit 1 year in area. It's here they told us that you received approval to pay annual corporation tax a year in arrears. So it means that the tax saving, okay, if you use this approach of putting the timing, and then you can look at year 1 like that. But if you don't put the timing to avoid wasting time, the tax relief of the tax that is supposed to be paid in year 1 will be paid in year 2. So you will claim you will save the tax in year what? In year 2. So here you get this figure, the capital allowance. Because we are getting the relief. Capital allowance times the 30%. I am putting it in year 2 because of that word, a year in arrears. Then the one of year 2, it will be this one. I put it in year 3. This one times 0.3. Then here I put the 11336 times 0.3. Then the one of year 4, it will be in year 5. This one times 0.3. That is your tax saving, or your tax relief. So in your computations, in your template, in your template, you put this. In your template, you put this. You put this. Yeah, 2, yeah, 3, yeah. So it means that in year 1 you have nothing. In year 1 you have nothing. Okay. But remember, there is always the other working that I told you. There is only the other working. I need someone. There is a person who is Nancy over Zam. There is a person who asked about the other working, okay, which I'm going to handle. The capital, the balancing allowance or balancing charge. That working. Where you compare the scrap value. So first of all, you will need to look at your scrap proceeds. Our scrap proceeds were how much? Our scrap proceeds were how much? Our scrap proceeds 20% times 9. It was like this, It was like this, okay? Compare this with your written down value. And that one was what? That one was this figure, this one. So compare these two. Ask yourself, do you have a balancing charge or a balancing allowance? A balancing charge is a scenario where you find that your scrap proceeds are higher than the written down value. There you look at balancing charge as capital gain. Those who did tax, who have already done tax, this is capital gain. Where the disposal is greater than the written down value, that is a gain. But here you have a balancing allowance, which you have to claim. This is a balancing allowance. Why? Why? Because the proceeds are less than what? The tax written down value. So here you have a balancing allowance. You have a balancing allowance of the difference. So you will claim a tax relief on this. So get the tax relief of 30%. 30% of 106. 30% times this figure. So this one will be added. Now you can get in your computation, in your template, when you're doing this tax relief, you can in year because this one will come in what? This one will be, remember this one you are dealing with year 4, so it means that since we are claiming a year in arrears, this one will be in year 5, claimable in year 5, because it is 1 year in arrears. You relied on written down value of year 4. Claim in year 5. So in year 5, you will have a total tax relief of this plus what? Plus this one. That is one approach. Another approach that I told you examiner is where is going is to get the net scrap proceeds, whereby you get your scrap proceeds of 1,900 minus this tax relief, the 332. Then you will have this net proceeds is the one that the examiner is now trying to record. Once you use this approach of recording net proceeds in your template, then don't record this where you have tax relief of year 5. Simply record this. Because within this net scrap proceeds, you have subtracted the what? Discount. But I would the shortcut would be just to record the scrap proceeds as this in your template, then record tax relief in year 5, the total, this one plus this one. But if you know what you're doing, there is no problem in recording net scrap proceeds. You record the net scrap proceeds, then where you have tax relief in year 5, only record this. All of you will be right. You saw what we did in August 2025, based on the what examiner was trying to do. Okay, I am done with this computation. What is left is the working about the financing effects.
Thank you. Good night.